Hi, this is Mani from BSc to NSE.com. So in this video, I'm going to talk about net asset value and what it means for an investor or a trader in stock market and how you should use that at various points of time, various stages as an investor or trader. Before I continue further with the video, I want to share that most of my videos, my book, EOD dashboard, or any tools, anything that I share is mostly ideas, and the intent of making the videos or sharing these kind of materials is so that it elevates your thinking and gives you a perspective. It'll give you an edge and learn and grow faster, and it has also helped me grow because of a lot of feedback that I get, that again improves my thought process. So the point I'm trying to make is that a particular strategy or an idea in a video, it need not work all the time, and it is not, I mean, I don't want you to also keep following something in a very rigid and a stiff manner. You need to be flexible with the idea, and you need to tinker around, and I expect you to evolve from the idea. And again, I as a trader or investor, I constantly try to change my ways towards approaching the stock market, be it investing or trading, based on my capital, based on my experience. The stock market keeps changing every day. What works today or for the next few years may not work 10 years later. So never hold on to an idea too rigidly. So be flexible. All the videos that I put are ideas and spark, which I expect you as a starting point. It's not the ending point, and it's not, that this strategy should always work for me. So it's a similar reason why I don't actually believe in AI or algos, because you will kind of settle down your thought process. You will always want one algo to work for you all the time, and that doesn't work in stock market, because there's going to be some other algo which will tweak your strategy and beat you at your own game. So you always need to be on your toes. You always need to try and learn and improve on your thought process, and to a point where you may not need to change. So coming back to the video of net asset value and how to use it as an investor and trader. So I'll run through the video, and I think after 3 or 4 minutes you will understand why net asset value is so important. And this is a self-assessment that you need to do yourself. It's very hard for somebody else to come and do this for you. So there will be a lot of self-assessment. I'll just give you an example of my net asset value and how I use it to decide as an investor and trader. Now, net asset value basically means if you sell off all your assets, your property, land, house, and if you settle all your negative liabilities like loans and all the other things, what will you be left with? If you sell off everything and liquidate everything, how much money will you have in net? Okay. Now, typical positive assets are property, land, or house, or flat, gold, mutual funds, equity portfolio, fixed deposit. So these are typical assets that people always try to build, and people will have a mix of it, or sometimes people don't have a property but they have gold, mutual funds, or FD or equity portfolio. So it will be a mix of things, and it differs from person to person. Negative liability is loans or EMI that you have. It can be a car loan, it can be a flat loan, it can be a property loan, it can be personal loan, it can be anything. And in case your monthly expenses are more than your monthly income, which means that you're actually bleeding on a monthly basis, and you need to somehow fix that up. So that's a different story how you fix it up. But if your expenses are more than monthly income, then that's also a negative liability on you, and any other kind of possible negative liabilities that you can think of. And number 3, so these two put together, once you offset, you will get the net asset value. For example, for me, I had a flat passed on to me by my parents, and I also have a house, individual house, which I took a house loan to build the house. So I eventually decided to sell off the flat to build my equity portfolio, and I was having deep thoughts as to whether I do it or not for a long period of time. And that's when the concept of net asset value came to me, as if like, so while selling the flat was worth around 50 lakhs, and the individual house that I have probably is valued somewhere between 2 crores to 3 crores, and including gold, mutual funds, FD, all this put together, my net asset value was probably worth somewhere like 3 crores. And at that time, my equity portfolio was hardly 5 lakhs, 10 lakhs, or 15 lakhs at top. And so at that point, I was contemplating selling the flat for a couple of years, and then I eventually decided to sell because my exposure to equity portfolio was, if I write it down here, 10 lakhs, and as opposed to my overall net asset of 3 crore, it was hardly 3%. And I had played around in equity markets for almost 7 years at that time, 7-8 years. So it was enough, and I was feeling very confident that I can pick the right companies for long term. So eventually I decided to sell my flat because my real estate exposure with respect to my overall net asset value was pretty high, and I was extremely confident as a equity market investor. So I decided to sell the flat at 50 lakhs, pumped it completely into equity markets. So currently my equity portfolio is say around 60 lakhs, and on a net asset value still includes the equity portfolio, so the net asset value stays the same. It is just that I had allocated it, shifted it out of the flat and pushed it into equity portfolio. And again, I'm just pointing this out as a example. I don't want people jumping in, selling their flat to push into equity. Now, currently my exposure to equity is say 60 lakhs over my net asset value of 3 crore, which means my exposure to equity portfolio is 20% of my overall net asset value. So even if for some reason that the real estate is not going down, but equity market goes to zero, it still erodes only 20% of my net asset value. So that's what it means. So the reason I chose to exit flat and push it to equity is because of very high exposure to real estate, and I personally don't expect real estate to rebound for the next 5 to 10 years. But and again, I loved investing, and I believe that I can pick good companies for long term. So I made the shift. So when you think, if you don't look at net asset value, and if you just judge somebody saying, oh, he sold a flat and he invested in equity, it probably looks a very stupid decision. But then when you take into account a person's overall net asset value and experience in market and how confident is he, and then after taking all that into account, this decision sounds very logical to me, and very realistic to me, and a good move, I think, after 10 years down the lane, if it works out well. So the same if you consider for another person who has the flat and he still hasn't paid off the loan, he doesn't have any other net asset value. So he's holding on to a flat of 50 lakhs and he still owes the house loan company 30 lakhs. So which means that his net asset value overall is probably 20 lakhs. Okay. So at that time, let's say he decides to sell the flat completely and put the 20 lakhs entirely into equity market and trading or investing. That is absolutely foolish, because he is dumping his entire net asset value and bringing it into the equity market. Now, it doesn't matter what the equity market valuation is. It can be a PE ratio of 12 and the markets have seen a huge crash. You expect a rebound. You can be the most experienced person, but still logically it doesn't make sense, because it's gonna cost you a lot of heartburn if you need to temporarily watch your capital erode. So this is an example of a person who doesn't have or who is exiting his complete net asset value and putting it into equity markets, into investing or trading. So I hope you got my point. And with respect to, let's say, somebody who's starting out fresh, and the third point that I have is, monthly savings capability, meaning you could be in a very good job where you're earning a lakh or a 2 lakh or and your expenses are very limited, or if you are just a fresh out of college and you're just into a very good job and which is very secure. But even though you may not have any assets, you may not have any assets from your parents as well, which you will get in future. You're still young, so you need to take that also into account. So you can still start building your equity portfolio slowly, or fixed deposit or gold and all those assets. And sometimes, even though the PE ratio is 24 right now and 24, 25 if you include consolidated earnings, NSE is showing non-consolidated earnings standalone. So even though markets are at high valuations, you're starting out fresh, and let's say somebody has net asset value of 3 crore with most of it in real estate, and he's just starting off. So you can start off, even a beginner can start off with very minimal amount like 2,000, 3,000 or 5,000 on a monthly basis. Invest equity even if the PE ratio is high, because if you keep waiting, then waiting is number one painful. It's very hard to stay out of the markets for too long. So you can start off with a very minimal amount. Somebody who has a net asset value of 3 crore can start off even though the valuation is high, because even if you're pushing in 3k, 4k or 5k at max per month, you're still pushing in only 60,000 a year. So it is very less when compared to your net asset value. So it doesn't matter even if the market PE, Nifty PE, when valuation is high. So you can continue to invest. So when I personally, so I asked to myself, when will I want to exit equity portfolio? So I'll tell you the ideal scenario. Let's say today I have a equity portfolio of 50 lakhs, an overall net asset value of 3 crore. Okay. Now assuming there is a big equity wave bull run, to know more about it, you need to watch my other recent video where I talk about types of bullish and bearish markets. So if a big wave comes, there is a chance that over a period of 10 years, the 50 lakhs that I've invested can become something like, say, 10 crores. And by that time, assuming my real estate is still the same value of 3 crores, it'll be 13 crores in net asset value. And out of 13 crores in net asset value, 10 crores is an equity portfolio, which means that 70%, my exposure to equity market has gone up to 70%. And if at that time the PE ratio is pretty high and I expect a fall, a crash like 2008 coming, then it makes sense for me to exit equity partially, say 50% or 30%. So I will bring down my equity portfolio from 10 crore to 5 crore and still not exit fully, because exiting fully and re-entering is a very tough thing to do, and staying out of equity market for someone who loves market is very difficult to do. So I'm just considering that, looking at net asset value, I'll just exit this, and 5 crore I can push it to FD and bring down the exposure to net asset value to, let's say, something like 30%, 40%. So that will put me at ease and allow me to watch the market fall and still be happy about it. And at the same time, once the markets have dropped, it will mean that I'll have so much in cash or fixed deposit or liquid instruments which I can bring back into equity market. So this is how I will want to do it. Today I don't want to exit my portfolio even an inch or even one bit, because my exposure with respect to overall net asset value, I feel comfortable at 50 lakhs and just 20% exposure. I don't want to exit at this point, even though I know that markets are at high valuations. And there has been no big bull run for the last 10 years, like a bull run where Nifty runs up by 200%, 300% over a period of 3 to 5 years. So considering all that, I haven't chosen to exit my equity portfolio. Now again, all these decisions like I said earlier, this is a self introspection kind of topic, wherein you need to decide based on your experience in market, your confidence in market, your net asset value and all this, and then take a call on whether you want to add equity or not. So similarly, for a trader, how much should I allocate for trading capital and max potential loss? So let me let me put as if with respect to my example again, so that you can again self-evaluate on yourself. Today, I restrict my trading in a way that I don't lose more than 5k in a day. So 5,000 with respect to my overall equity portfolio of 50 lakhs is hardly a 0.1% loss. Or with respect to my overall net asset value, it is probably 0.01% of my net asset value. So when I think along those lines, a 5k loss doesn't bother me as much. So I still try to be very effective with my strategies and very effective, try to be more consistent with my trades. So I try to restrict my trades in a way that I don't lose more than 5k, or I don't take sufficient risk. So I focus on risk containing and ensure all that happens. Based on that, I allocate the trading capital. So if a particular, sometimes I even get into a trade position in option selling where my margin utilization is around 10 lakh rupees, but the potential risk in the trade is very, very less. So I enter into those kind of trades, but I eventually try to come out even before the loss explodes to something like, more than 5k, more than 10k. Then I begin to, reevaluate and look to come out. Correct. So you need to look at that aspect and push in trading capital. So capital depends on the type of trade you are going to do. If you are going to do a very high risk trade, then you should probably invest with only 5,000 or 10,000. If you are going to risk very less, wherein option selling with cover, wherein the risk is defined and the risk is limited and the probability is very, very less, then you can have a higher capital. So based on the strategy that you trade, based on the net asset value of the person, and the possibility of risk and loss and consistency that you've seen as a trader over the last 1 year, based on all this, you need to decide what should be my trading capital, and you should decide based on that. Correct. So 6th point is again experience in markets. Are you consistent in profits and stock picking ability? So try and see if you're consistent, if you are consistent in trading as well as investing over minimum the last 3 years. Because a short period of time, anybody can be successful for 2-3 months. It's very easy to be successful in trading as well as investing for a period of 3 months. So to be consistent at it over a period of 3 years is very difficult. So if you are consistent over a period of 3 years, then again taking into account net asset value and everything else, I'm sure you will be at a good point to decide as to what should be your trading capital. Can I scale up the capital or not? And all these questions will get answered. And I think I've made my point with respect to this topic. That's it for now. Thank you, and thank you for watching the video. Subscribe to our channel and stay in touch. Thank you. Bye-bye.